Hello, welcome back guys. In this video we are going to take a look at Invitae Corporation. This is a company that was up more than 300% yesterday. So what is the deal? Right now in the pre-market is going to be down about 19%. But what is the deal actually? Why was this stock up that much? And after it being down 1/5 of its price right now in the pre-market, I'm supposing when the market opens it's going to be at about 1/5 lower. Is it still a buy? So let's take a little bit of a look what happened here. So in terms of the news, the stock news of the company, so why it skyrocketed 278% yesterday, and again at some point it was actually more than 300%, which is absolutely insane. Now, as you'll see, investors are responding positively to the company's second quarter results. And positive is one way to put it. This is absolutely insane. Now, of course, the company has been devastated. So you can take a look at the metrics tab and you will see that its 1 year high price was $32. So even at this current insane increase, it's still down 74% almost. And you can kind of see here, if you go back, like, let's say 3 years, you will see this little spike over here, which is what caused the increase yesterday. But overall, it has been going down, and it used to be much higher, way higher, actually even 60 at some point near that. Okay, so there's still a lot of room to run if this is a good company, that is. Now, what did they do? They reported a Q2 EPS of 0.68, which was 8 cents higher than analyst estimates of 0.76. And the revenue for the quarter came in at 136.6 million compared to an estimate of 137.5. So a little bit of a loss there, a little bit of a miss, but still very close. In terms of guidance, the company expects a low double-digit growth rate for its full year 2022 revenue over 2021, and the longer term revenue growth rate is expected to return to about 15 to 25% beyond 2023. So we are to be expecting maybe something like 7%, 8% for the next year, and after that they are telling us that the company is going to be growing at between 15 and 25%. Now, after the company reported earnings, you'll see the stock gained attention across various social media platforms. So this may be becoming a little bit of a meme stock right now, and it is driving a short squeeze as over 20% of the float was short, and that definitely plays a big role. In case you don't know how that works, if a lot of the float of the company that the company is trading is shorted, then short sellers are looking to cover their short positions. And in order to cover a short position, you need to be buying back shares. And so when more and more people flock to actually buy the same amount of shares, a specific amount of shares, that they need to be able to cover their investment basically, then the stock price will go higher and higher. And this is what happened with this one. There was a massive stock squeeze. But is it still a good company to buy is the question. Now, of course, this is not a very well-known company. You can take a look at the company profile page here that we have in our tool, and you will see that it is a medical genetics company, integrates genetic information into mainstream medicine to improve healthcare of people in the United States, Canada, and internationally. So pretty much a company that operates in healthcare. And again, it has been completely devastated, down significantly, but these latest earnings do provide a little bit of hope for the company, potentially looking to do better through the years. Now, in terms of the income statement here, you will see that the company has been growing the revenue, and this is fantastic to see. They have been growing the revenue at a very nice pace here. But in terms of the net income, though, they have been in negative territory for a while now, and they were looking to be getting a little bit better, but then actually went down again. Then they are currently sitting at minus 379 last year. And in terms of their balance sheet, you will see here that their company has actually been having about 3 billion in terms of total equity and 2 billion in terms of total liabilities here. And in terms of the cash flow statement, you will kind of see that the company is minus in the operating cash flow, and they are investing a little bit, for the most part, capital expenditures and some acquisitions, and also, as you'll see here, financing themselves, so getting some debt for the most part, and also issuing common stock. We will examine that, of course, in our metrics page next. This will tell us a few things about the company and what they're doing with their metrics here. Now, the P ratio and price to free cash flow ratio negative because the company is losing money still. Now, they are a little bit better in the amount that they are losing, but still they are losing money. And they have been also printing shares like crazy, printing tons of shares, issuing stock after stock. Pretty much, look at this, 500% of an increase in terms of their outstanding shares count. That's 5 times as much as they had. And so that's a steep increase here, which you hate to see as a potential investor. But again, it can cause, at any time, it can cause short interest. When the short interest is high, it can actually cause a massive stock squeeze. And this seems to be happening right now, a short squeeze. Okay, in terms of the revenue, we saw it. It has been growing, but the net income has been going down. And the same thing with the 5-year free cash flow. Growth is also negative, and it's only the total equity that is going up, because we know the drill. They are issuing common stock. So this looks like a little bit of a sketchy company to potentially invest in, although we will try to get a valuation, because this has been battered down tremendously. So it could potentially still be a buy in some situations. We will see that. Now, in terms of the debt that the company has, it's not that much here, but remember, the company is not making free cash flow, which is problematic, and so all these returns are going to be negative here, which is not a great picture, of course, to see. Now, let's use our stock evaluation tool. Now, we'll see whether it makes any sense to be buying this one real quick. And remember, the revenue growth for the company has been amazing, but they have declared that they will be doing about 15 to 25%, while next year is actually going to be even lower. So we're going to go between these values. We are going to go, let's just go one which is going to be lower. Let's just go 8%, which is going to be the single one, the single digit one. Then we're going to go 12, and then we're going to go 15 in the case that they actually achieve this 15% for the next years. And the problem is, the big problem here is the margins of the company. They are always negative, and pretty negative at that. So we'll have to assume some at least marginal profitability, assume that the company will be becoming profitable at some point. And so for this reason, we will be trying something that's sort of like a marginal profit here. 3, 5, and 7 is what I want to try in this one, and see what we're getting out of these expectations. In terms of free cash flow, again, the company all over the place have been losing free cash flow. So we will go with something that is sort of like standard, 80%, 90, and 100. And in terms of annual return, we will do our usual 13%. Remember, we can always get about 10% just by buying an ETF, like an S&P 500 ETF. And so this is more risk, so we need to be making more money. And so in this one, because it's riskier, even riskier, you could even try 15%. But let's just try 13 and see where we're getting with this one. And so you will see that even at our current price, we are still expensive here for a short-term hold. We are not extremely expensive, though. I mean, remember that this is going to be at about 6 or so right now, 20% down. So, and also before yesterday's increase, it was much lower. And so back then, it may actually have been an interesting purchase. Right now, it's becoming a little bit expensive here. And in order to actually sustain this kind of valuation, this kind of current price here, let's just say it was $6, we would need to have much better projections here. Let's just say 25% and 10% in terms of net income margin. Maybe we can achieve it by that. Even then, we are still in the red, but we are closer. So we would need something that is significantly better here. Maybe let's just try 35%, see when we're getting there. Yeah, we're getting there with 35, maybe even, let's just try 32%, for example. Yeah, 32% or 30% with a net income margin of 10% could do it and would do it for a buy. But right now is, again, we are actually much more expensive. And I'm always getting confused by this price, but the actual price is 6 point something, I suppose. So we need to factor that. And maybe even 25%. Yeah, we are still in the green today. Again, we need to factor the fact that the company will open up at about, 6.8 when the market opens today. Also close to 7. But yeah, that's what I wanted to talk about in terms of Invitae. An interesting company, an interesting stock that we need to be paying attention at, especially if it continues going down a little bit, just because it has been, it has been actually having some action here, and the low amount of shares and the fact that it is sorted that much can actually give a potential entry either for a short or a long purchase here. Although for this one right now, at the current situation, I would be very cautious about buying this one. Maybe if it has a steep decline of like 50%, it could run up again. But right now, at yesterday's almost 300% increase, it's going to be tough for the company to run that much again so quickly. It may have to, rest a little bit before it does that again. But tell me what you think about this company, Invitae. And remember to leave a like and subscribe if you are not a subscriber. And also, you can become a Patreon and gain access to this too. Thanks for watching this video, and I'll see you in the very next one, guys. Bye-bye.